10 million barrels per day. That is how much Gulf oil production has already been cut as of March 10th, before Iran's new supreme leader even opened his mouth. 10 million barrels per day of crude gone from global markets, taken offline by 7 Gulf nations: Saudi Arabia, Iraq, the UAE, Kuwait, Qatar, Bahrain and Iran itself, because the Strait of Hormuz is closed and there is nowhere for the oil to go. Storage tanks are filling, pipelines are at capacity, ships are not moving. The Arab oil embargo of 1973, the one that caused gasoline lines around the block, quadrupled oil prices in 6 months and triggered a global recession, removed 5 million barrels per day from global markets. This crisis has already removed twice that. And then, on Thursday afternoon, Iran's new supreme leader gave his first public statement since his father was killed 14 days ago. He used it to say one thing about the Strait of Hormuz. He said, "Keep it closed." 10 million barrels per day, and now a formal policy declaration from the man who controls whether any of it changes. That number is what this episode is about, and by the end, you will understand exactly what it means for your position. Good evening, I'm James Harlow. Welcome to The Right Chapter, where we connect the world's biggest headlines to the assets that respond to them. Let me tell you what happened on Thursday and why it matters more than any single day this week. The war between the United States, Israel and Iran entered its 13th day. For 12 of those days, the question the oil market has been trying to answer is the same one it asks at the start of every geopolitical crisis. How long? That question has no mathematical answer. It has a political one. And for the past 4 days, that political answer had been coming only from one side. President Trump told reporters on multiple occasions that the war would be over soon. He told G7 leaders on a call earlier this week, according to a report from Axios, that Iran was about to surrender. Energy Secretary Chris Wright told CNBC that ship traffic through the strait would resume within weeks. The market partially believed that narrative. Brent crude had pulled back from its intraday peak of $119.50 to close around $92 on Wednesday, pricing in a resolution that appeared, from the American side at least, to be approaching. Then Mojtaba Khamenei spoke. He is 36 years old. He is the son of Ayatollah Ali Khamenei, who was killed by Israeli strikes at the outset of Operation Epic Fury on February 28th. He was named Iran's new supreme leader on March 9th, 4 days before this statement. He had not appeared publicly, had not issued a written statement, had not been seen. There were reports of minor injuries from the initial strikes. There were questions about his capacity to lead. Markets were treating his silence as a potential opening. On Thursday afternoon, Iranian state television broadcast a message attributed to the new supreme leader. An anchor read it aloud in Farsi. It was not a ceasefire signal. It was not a negotiating position. It was a strategic declaration. The key line, translated by Reuters: certainly, the lever of blocking the Strait of Hormuz should still be used. He called the strait closure a tool of pressure against the enemy. He said all US military bases across the Middle East should close immediately, and warned they would be attacked if operations continued. He vowed Iran would not refrain from avenging the deaths of those killed, including his father, and he called on Iranians to remain united and attend Quds Day events, a signal that the Islamic Republic's domestic political machinery remains intact and operational. There is a detail in how this message was delivered that is worth holding on to. Mojtaba Khamenei did not appear on camera. His statement was read by a state television anchor. That means 2 things. First, his physical condition remains unknown. He sustained a fractured foot and other injuries and has not been seen publicly. Second, and more importantly for markets, the Iranian state is functional enough to broadcast a formal policy statement from the Supreme Leader's office. The institution is operating, the policy is deliberate. This was not a message of a regime in collapse.
It was a message of a regime that has decided what it wants and is communicating it clearly.
The oil market responded the way it always responds to clarity. It moved in the direction the news pointed. Brent crude closed Thursday at $100.46 per barrel, the first settlement above $100 since August of 2022. West Texas Intermediate settled at $95.73, up 9.72% on the day. As of Friday morning in Asian trading, Brent futures are holding above $101. Brent is now up approximately 38% since the war began 14 days ago, from a pre-war level of $72.48.
The IEA published its monthly oil market report on Thursday, the same day as Khamenei's statement. The headline of that report, "The war in the Middle East is creating, in the IEA's exact words, the largest supply disruption in the history of the global oil market." The IEA is the institution created after the 1973 oil crisis, specifically to prevent this from happening. When it uses that language in an official monthly report, it is not editorializing. It is making a formal assessment for the record.
Here is the mechanism, and I want you to understand this completely, because the surface level story, oil goes up when there's a war, is not sufficient to explain what is actually happening.
The Strait of Hormuz is 13 miles wide at its navigable channel. It sits between Iran's southern coast and Oman's northern coast. Through it flows approximately 20% of the world's daily oil consumption, roughly 20 million barrels of crude oil and refined products every day. There is no alternative route at scale. Two bypass pipelines exist: Saudi Arabia's east-west pipeline to the Red Sea port of Yanbu, and the UAE's Habshan-Fujairah pipeline, but they are already running at maximum capacity, and together they cannot replace what tankers carry through the strait. Every analyst tracking this has confirmed those pipelines were fully deployed within the first week of the crisis, and oil prices are still at $100. So the bypass routes are not a solution. They are a ceiling on how bad things could be without them.
What has changed in the last 48 hours is not the physical reality of the strait's closure. Ships have not been moving through it in meaningful volumes since the war began. What has changed is the political signal. There was a scenario actively priced into oil over the past 3 days in which the new supreme leader, weakened and wounded, might find a way toward de-escalation. That scenario required his first public statement to be ambiguous, to leave room for negotiation, or to signal flexibility on the strait. His first statement did none of those things. It named the strait closure as a deliberate strategic instrument. That removes an entire category of near-term resolution from the probability distribution oil traders are working with.
The structural data that gives this its weight comes from the IEA's Thursday report. By March 10th, which was already 2 days ago when the report was published, the IEA estimated that Gulf production cuts had reached at least 10 million barrels per day of crude and other oil products. That figure represents cuts across most of the 7 Gulf nations that depend on the strait for export. The mechanism is simple. If you cannot ship oil because tankers cannot safely transit the strait and your storage is filling up, you cut production. You have no other choice. The oil that cannot be moved cannot be produced indefinitely. And as Amjad Bey Seishu, chief executive of British oil producer Enquest, told CNBC's Squawk Box Europe on Friday morning, every day of delay represents another 20 million barrels removed from global markets. He called this probably longer and harder than any prior crisis, and said he was watching for the downsides rather than the upsides.
Now let me give you the historical comparison, because context always matters more than the number alone. The Arab oil embargo of 1973 lasted 5 months. It removed approximately 5 million barrels per day from global markets. Oil prices quadrupled. The United States experienced its first gasoline rationing since World War II. The OPEC embargo triggered what economists now call stagflation, simultaneous high inflation and economic stagnation that lasted the better part of a decade. That disruption, 5 million barrels per day, is now considered the defining energy shock of the 20th century.
The current strait closure is removing twice that volume, 10 million barrels per day, and the rate of removal is increasing, not stabilizing. The 1973 embargo involved a deliberate political decision to cut supply to specific countries. This crisis involves a physical choke point that cannot be negotiated away country by country. It affects everyone simultaneously. China, India, Japan, South Korea, the four largest Asian importers, account for roughly 75% of the oil and liquefied natural gas that normally flows through the strait. They cannot find alternative supply at anywhere close to current volumes. South Korea's Kospi index suffered its biggest single-day crash since the 2008 financial crisis in the first week of the war. India's energy minister announced fuel use restrictions for businesses. Now, I want to give you the bear case, honestly, because this channel does not exist to confirm what you already think. The argument for lower oil prices, the case against the current level and direction, goes like this. Trump's statement Thursday night was significant in its own right. He told followers he has unparalleled firepower, unlimited ammunition, and plenty of time. But those are the words of a president who has also, twice this week, signaled the war is nearly over. The futures curve for Brent crude, the price of oil in future months, is actually declining from the front month, meaning traders believe the current level is temporary. Thoughtful Goldman Sachs revised its Q4 2026 Brent forecast to $71, which is a price below where oil was trading before the war began. Iran's president, Masoud Pezeshkian, laid out three conditions for ending the war: recognition of Iran's rights, reparations, and guarantees against future aggression. That is a negotiating position, not a refusal to negotiate. And the US Navy, according to Energy Secretary Chris Wright's comments to CNBC on Thursday, is expected to begin escorting tankers through the strait by the end of this month. That is the full and honest version of the case for lower prices. Now, here is why the data, as of today, does not support pricing. The Goldman Q4 forecast of $71 is a year-end projection. It requires the strait to reopen, production to recover, and strategic reserves to be replenished, all of which takes months after a ceasefire, not days. In Commodities Desk published a note Thursday that said directly the only way to see oil prices trade lower on a sustained basis is by getting oil flowing through the Strait of Hormuz. Failing that, the market highs are still ahead. The futures curve showing backwardation near month prices above future month prices is not a signal that traders expect oil to stay at $100 forever. It is a signal that the supply emergency is priced into now, and that traders believe it will resolve at some point. That is different from saying it will resolve soon. Adam Crisafulli, head of Vital Knowledge, wrote Thursday that Iran's strategy of sowing economic chaos in the Gulf is working. Saul Kavonik, energy analyst at MST Marquee, noted that the IEA stock release will only close up to a quarter of the supply gap. And the most clarifying data point of the week, the US Navy is not escorting tankers through the strait yet, and Energy Secretary Chris Wright confirmed Thursday it is not ready to do so. That is the single most important variable in the near-term oil price equation. When the US Navy begins escorting ships and those ships start moving safely, that is when you will see a sustained move lower. That has not happened. Every number I have given you today is publicly available. Check the IEA monthly oil market report, published Thursday, March 12th. The Goldman revision was reported by Reuters. The Enquest CEO interview ran on CNBC Squawk Box Europe Friday morning. The ING note was published Thursday. The floor that must hold is $90 on Brent. That was the approximate settlement level before Khamenei's statement moved things above 100. A sustained close back below 90 would tell you the market is pricing in either an imminent ceasefire, a confirmed naval escort corridor through the strait, or both. Below 90 is the peace trade, and nothing in Thursday's statement or Friday morning's news suggests it is available yet. The resistance that must break is $110. Brent briefly touched $119.50 intraday on Monday before pulling back. The gap between Thursday's close of $100.46 and that intraday high is roughly $19. If the Strait remains closed into next week, and Khamenei's statement makes that more likely, not less, the Rystad Energy 2-month scenario of $110 becomes the near-term base case rather than a tail risk. A sustained close above 110 tells you the market has decided this is months, not weeks. The target in the extended disruption scenario is $135 to $150. Rystad Energy's Janiv Shah placed Brent at $135 in a 4-month disruption scenario. Wood Mackenzie placed $150 on the table if traffic does not resume. Oxford Economics modelled $140 as the level at which the Eurozone, the UK and Japan enter economic contraction. That is not a price target. That is an economic breaking point. The market is not there yet. It may not get there, but it is the number that defines what a prolonged closure actually means for the world economy. And every investor with energy exposure should know exactly where that line sits. That is your map. Hold it and do not mistake a resistance test for a reversal. The most important institutional signal this week is not an analyst note or a fund flow. It is the statement from US Energy Secretary Chris Wright that the Navy is not ready to escort tankers through the Strait of Hormuz yet, and likely will not be until the end of March. This matters more than almost anything else said this week because it gives you a specific timeline. The US government's own logistics estimate for restoring oil flow is 2 to 3 weeks from today. That is the window the market is currently pricing against. Ing said it directly, oil lower only when the Strait flows. Wright said the Strait flows in roughly 2 to 3 weeks. That means the near-term direction of oil is dictated by whether March 31st looks like a realistic date for naval escort operations or whether that deadline slips. Watch the International Maritime Organization. They announced Thursday that they will convene an extraordinary session next week to discuss threats to shipping in the Strait of Hormuz. The IMO is the United Nations body that governs international shipping. An extraordinary session is not routine. It signals that the global shipping community does not believe the corridor will reopen by private commercial decision alone. They are looking for an international legal and operational framework that is a timeline extending signal, not a timeline shortening one. Now let me make this concrete. If you are holding 100 barrels of crude exposure at today's Brent price of $100.46, that position is worth $10,046. At the ING target level, where the market must reach before sustained relief can appear, meaning full straight flow restored, the question is simply duration. At $110, 100 barrels becomes $11,000. At $135, it becomes $13,500. At $150, Wood Mackenzie's extended disruption level, it becomes $15,000. If you are holding 500 barrels of exposure, today's value is $50,230. At 150, it becomes $75,000. The arithmetic is not complicated. The only variable in this equation that the market does not yet know is how many days remain before the US Navy successfully escorts a convoy through the Strait of Hormuz and ships begin moving again. Everything else, the supply loss, the reserve bridge, the political signals, flows from that single unknown. Tomorrow's trigger is specific, and it is the FEDA. The Federal Reserve's Open Market Committee begins its 2-day policy meeting on Monday, March 16th. The rate decision and press conference from Chair Jerome Powell comes Wednesday, March 18th at 2 p.m. Eastern Time. This is the most important Fed meeting of the year so far, and the reason it matters for oil is not the rate decision itself. Rates are almost certainly staying at 3.5 to 3.75%. The reason it matters is what Powell says about the inflation outlook. The February CPI came in at 2.4% year on year, clean in line, the kind of number that normally gives the Fed room to discuss future cuts. That number does not include a single day of war-era energy prices. Gas at the pump is now at $3.58 a gallon nationally, according to AAA, up 20% in 1 month. When April CPI is released in early April, it will be materially higher. The question Powell faces Wednesday is whether the oil shock is transitory, which is the word the Fed famously regretted using about post-COVID inflation in 2021, or whether it is persistence enough to delay any rate cuts or even require a hike. Goldman Sachs has already revised its 2026 US inflation forecast up by 0.8 percentage points to 2.9% and trimmed GDP growth to 2.2%. In the extreme scenario, oil averaging $110 through March and April, Goldman puts inflation at 3.3% and raises recession odds to 25%,